It's 10 o'clock, so let's get this show on the road. Welcome, everyone. Thanks for attending today. It's a great pleasure to host this session and to welcome you today. My name is Michael Churchill, and I head Peloton Corporate's valuation business. I'll be moderating today's session, and I'd firstly like to acknowledge the country on which we join together today, wherever that may be around Australia. In the spirit of reconciliation, we acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today. Today's session is about sharing some rare insights into how private equity works, and in particular, the strategies which private equity employs to increase the value of the businesses it invests in. Of course, with the ultimate objective of earning exceptional returns for the investors in the funds that are private equity. Most of you know that Peloton is focused on all things value measurement, value creation, value advisory. At the core of our team's skill sets are three things: an understanding of capital markets, an understanding of the strategic and competitive landscape that businesses operate in, and financial analysis. We think that without a thorough understanding of capital markets and the competitive landscape in which a business operates, there's little value in undertaking financial analysis. That, along with a deep understanding of our clients, is what sets us apart. Today's presenter is Lewis Senra, one of the awesome Peloton team and someone who brings a truly unique view on the world in which we all operate. Lewis has had an interesting past in terms of his history. He's a former CEO, he's a former barrister, and today he reveals some of the secrets from his time as the Chief Value Officer of a Brazilian private equity firm. Lewis's role in Peloton is head of what we call the Private Equity Paradigm Services, which provides business owners with access to the strategies that a private equity firm would employ if a private equity was a shareholder in your business. Today, Lewis will provide you with a fresh view on the value creation objective. Even if you've spent a great deal of time thinking about how you can increase the value of your business, we're confident that you will leave today with a new perspective, one that reflects the intensity of focus that private equity brings to every business. Lewis will speak for about 45 minutes. We'll turn to Q&A at 10:45. I'll hand to Lewis in a minute. If you're not familiar with Teams, which is our favourite platform, there's a Q&A button, which, if I'm not mistaken, is the 7th from the left on your screen. If you press on that, it'll open a dialogue box and you can put your questions in there. I'll moderate the questions in the last 15 minutes of the session. If we don't get through all the questions, could you please email them to Lewis? And if you don't have Lewis's email address, you'll find it on the website. So Lewis, over to you.
Well, thank you, Michael. I put together, I think, quite a lot, so I will try to speak as fast as possible. And let's see if I really can finish it in 45 minutes.
I'll ring a bell or something, Lewis, if we're getting close to the 45 minutes and we want to turn to Q&A, we might need to break the session into two, and we'll let everyone know if that's the case.
Now, give me a 10 minutes warning, would be really good.
I will.
Perfect. So I think we should start trying to answer the question that I think it's the most important question inside a company. I think this question, how to create company value, needs to be the centerpiece of the thinking of every company director and every company officer every day. This is the question that they need to try to answer every day. So how to create company value. But before I try to answer this question, let's explore a little bit more what is value, what is company value. There is one centerpiece of knowledge in the private equity that is the multiplier. The multiplier means the ratio, the relationship between the free cash flow value and the net tangible assets, how much you need to invest to have that free cash flow value. Inside every company, you have three different levels of value. The first one is the net tangible assets. It's not exactly your book value because I'm removing all the intangibles of your company because they are not assets that in theory can liquidate. But let's work with net tangible assets. This is your first level of value. Those are the assets that you own less the debt related to those assets. This is the first level of value. But on top of it, if you use those assets, if you have those assets and you using your knowledge, individual knowledge or company knowledge, you are able to create a free cash flow. Now you have the right to have a free cash flow value. And this free cash flow value usually brings the second level of value, that is the operational premium. So anyone that would like to buy your company, they would pay the net tangible assets plus a premium that is this operational premium. Your knowledge is worth some value on top of the raw assets that you have inside your company. So the knowledge on how to operate assets and create free cash flow value is worth. This is the second level of value. And there is I don't think it's a mistake, but most of the people, when they think about free cash flow value, they're thinking about free cash flow. But free cash flow value actually has several other factors that will influence the free cash flow value on top of the free cash flow. So you have three other factors here that are going to influence free cash flow value. You have company risk, you have growth rate, and you have strategic premium. Those are several other factors that will deeply influence your free cash flow value that I think are undervalued on the path to value creation. But on top of those two levels of value, there is a third level of value. That is your capacity to improve multipliers, to increase the operational premium, or to reduce the first level of value, that you can improve this relationship between free cash flow and net tangible assets, business improvement. Your capacity to make merger and acquisitions is something that will create also value, and your growth engine. So this is let's say more dimensions to the company value. I think one of the biggest problem of, let's call, normal company, non-private equity thinking, is that when we ask how to create company value, a lot of the times the answer is, I have to make my company more profitable. The company needs to improve profitability. And this is just one of the ways to create value. Actually, we have several other dimensions, we have several other strategies, paths, tools to create value. And I think this is the biggest difference with private equity and your normal executive team. Executive teams are really good in operating the business, and they will focus in creating more operational premium. And basically, and specifically, they will try to improve free cash flow. And the private equity actually comes with much more tools, much more dimensions. And this, I think, is what explains why private equity can buy a company that has a fantastic executive team and on top of it, create value. We create value because we are not just there in one of the dimensions trying to improve that dimension. We are looking at the company from a much wider perspective. We are looking at company value creation from a much wider perspective, and improving those other areas that the normal executive team is not looking at. So let's try now to answer the question, how to create company value. I think actually the question that we are trying to answer as private equities is how to create additional company value. The company has a value. Every company right now has a value. 100 million, 50 million. Michael definitely is the best person to answer what is the company value of any company. But how can we create additional value? How can we transform a company that is worth now 50 million into a company that is worth 100 million? And there are two ways to do it. And they are not exactly improve profitability. The two ways are you can improve multiplier. And one of the ways that you can improve multiplier is making the company more profitable. And the second way is to create new cash flow units. So add new cash flow generators to your company. You can make the cash flow generators better, or you can add new cash flow units to this portfolio of cash flow units. And this is a big difference from the private equity perspective and your normal company perspective. When we look at a company, we never look at a company as a company. We look at a company as a portfolio of business units. Actually, we prefer to call them cash flow units, cash flow generators. And of course, this is nothing new. Most of the big companies will subdivide the company into different business units or business geographies. I think the difference here is that we go much deeper. So if a company, an ASX listed company, is subdivided into 3 different business units, we would subdivide this company into 100 business units, 100 cash flow units or cash flow generators. Even small companies, usually we are going to subdivide this company into 20, 30 different cash flow generators. And when you do it, you have a much better understanding about the company. And when you do it, actually, what we are trying to understand is what is inside the company, which are the portfolio, which are the cash flow units, which are the investment opportunities that has the best multiplier, that I can invest 1 million and they will deliver a cash flow value of 2 million. So which are the really good parts of this company? Which are the things that this company is the best in class? And what is inside this company that the company is not excelling, that is underperforming, that someone else in the market does much better than us? And this will be a great source of value opportunity to identify those value additions opportunities. Before we really go through the value path and how to create the value, I'd like to throw one curveball here, that is, why does a private equity firm buy a company? And in this instance, why anyone would buy a company, or why anyone would own a company? And the answer is actually not to have access to their cash flow. Okay, this idea that you buy a company to receive the future cash flow of this company is wrong. Okay, this is a misunderstanding, because you'd never buy a company because of the cash flow, because you are paying upfront the fair value of this free cash flow. The valuation of company, the fair price that I, as a private equity, would buy a company is already the future cash flow discounted to the present value, considering the risk of this company. So actually, I'm paying upfront to receive in the future the cash flow. So I cannot create return on investment with the idea that I will buy a company just to receive the future cash flow of this company. So the answer of the answer to this question needs to be something else. It's not to have access to the cash flow. Actually, we buy a company to have access to its unique investment opportunities. Every company inside the company, they have investment opportunities. I have places to allocate capital that will deliver a return on investment much better than I can find in the open market. This is the reason why I buy a company. This is the reason why anyone that owns a company wants to own that company. Because if you don't have access to any unique investment opportunity, is definitely the moment to sell this company. So just have this in mind when a private equity is trying to buy a company. We're not actually thinking about cash flow value. Okay, we are not thinking about it. This is the transaction value. How can we create the additional value? How can we take this company and double the value of the company? And we can only double or create value when we have access to unique investment opportunities. So a lot of our job as private equity, when we assess a company, will be exactly to find out those unique investment opportunities. When we look at the company, we are not trying to evaluate it. The transaction team will be doing it, or the investment banker that we hire will be doing that. What we will be doing is what is the unique investment opportunity that is inside this company? How much money can I allocate into those unique investment opportunities? This is what is behind our thinking.